Since 2022, I've been using these three markets to track the US indices. As long as the US bonds are not in a downtrend, the yield curve is not inverted, and inflation is not making a comeback, US indices should remain resilient for 2026. Although the US indices closed higher in 2025, and we saw that the Dow Jones between 2024 and 2025 had closed up 13%, S&P up 16%, and Nasdaq up 20%. Their performance have lost its shine compared to a much smaller market such as Singapore Straits Times Index. Why is this so? Because the US bonds remain on a downtrend and inflation is at a crossroad, failing to move closer to the 2% target. And although the yield curve is no longer inverted like the one in 2022, but the borrowing cost as of current is still much higher than those of 2022 and before. My name is Con Hao. My work in this channel is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. And currently, the US bonds is still negative. Inflation, it is uncertain, and yield curve, it is unclear. And therefore, I remain cautiously bullish on the US market and exactly what to look out for in 2026. And that's exactly my point. These three markets, the US bonds, inflation, and yield curve. So the checklist is now the bonds is down. So I have a not too happy face here, but this too is still unsure. So once it crossed, this too became an unhappy face, and that is where I'm the most concerned. Now, this is how it goes. If US bonds remain negative, which it is right now, and inflation, now this is what I'm looking for, and if turn adverse, signaling a renewed rise, and based on the current geopolitical and other events, there is a risk that that may happen. And yield curve suddenly turn into negative, which is into inversion, this would be bearish for the US market. Now let's wind back a little bit to study the impact of these three indicators of market on the US market. If you're not aware, during this period, it was a whole year of bearishness and after June 2022. So what happened here is that during the same period, we saw that the bonds for the first time broke below this 40 years uptrend, and it broke below. And that was during April 2022. And then we saw that inflation reached its peak in June 2022, and not forgetting that inflation started to rise even before that. That was during 2022. And then we saw that in July 2022, the yield curve or the short-term borrowing is higher than the longer-term borrowing. Just imagine your fixed D, your fixed deposit, a three months fixed deposit, it gives you a higher payout than your long-term borrowing. And this is what there's an inversion in the yield curve. Of course, today the subject is not the yield curve, but the implication is there whenever the yield curve, the shorter term borrowing, the rate is higher than the longer term borrowing, and that spell some trouble. Therefore, since then, I've been hedging into, how do I hedge back then? Is that I hedge into by investing into gold and silver. So I spoke a lot about gold. But at one point in 2024, I believe that silver will catch up, and it did in 2024 and 2025. And you can visit my past tutorial on how I formed that conclusion to getting into different position for gold and silver. And I understand that some may say that precious metals prices are too high. Therefore, in the recent tutorial, we discussed about platinum. And it seems like there is a rotational play between gold, silver, and now platinum looks interesting. But of course, my topic is not about gold, silver, and platinum today. But if we study into the historical behavior, all these three metals move in tandem together. And there's always rotational play. First by gold, followed by silver, and then platinum. Now, let me just come back to where my topic is that if you find that, or maybe you may want to ask me that, is there any other alternative than precious metal? Now, the thing is this. If you are like me, you subscribe to the idea that inflation fear is far from over, and we can hedge and trade into the yields directly. And there are yield instrument like 2 years yield, 5 years, 10 years. Is all available to hedge by getting a long position in them. For example, if you feel that the interest rates maybe continue to move higher, the yield to move higher, what you can do, which also means that inflation is going to pick up, we can get in advance by having a long position in the yield instrument. Or alternatively, we can get into position into the bonds market. For example, this is what was a study back then, even at this point in time, or even at this point in time, we spotted an unusual behavior that it picked in 2020. You can visit the yearly chart, you'll see an inverted hammer very nicely there. And then we saw during this period break below the 40 years of uptrend. And that was the period where I start to advocate on different tutorial that it's time to take a very close look on the bonds. And it is not the liberation day that caused the bonds market to sell off. In fact, in the year 2022, when inflation hit a high of 9%, that was where the action begins. And from there, my position for the bonds is that instead of buying on dip all this while, which is I used to be a financial broker, then my client asked me, bonds is at a buy. I totally agree with them, buy on dips when opportunity arise. But after 2022, my position have changed. So my position here is to sell into strength as much as possible when opportunity arise. I have started monitoring these three markets since 2022, and it should be the tools to apply for many years to come. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that you stay through this tutorial. You have many great trading weeks ahead.